Imagine you buy a pair of sneakers, $120, you split it into 4 payments, $30 every 2 weeks, no interest, no fees. You walk out feeling like you found a cheat code. Now imagine doing that with your groceries, your gym gear, your flight home for the holidays, your new laptop, your skincare routine, your concert tickets. Each one feels like $30. None of them feel like $120. And then, quietly, without you really noticing, you have 6 of these things running at the same time. And you do the math one morning, and it is not $30. It is not even $120. It is something much larger. And it is all due this month. That feeling has a name: debt fragmentation. And it is by design. Buy now, pay later has become one of the fastest growing financial products in the world. In the United States alone, BNPL transactions crossed $75 billion in 2023. Globally, the market is projected to hit $700 billion by 2028. Afterpay, Klarna, Affirm, Zip, Sezzle, they are everywhere. Embedded into checkout pages, built into Apple Pay, partnered with Amazon, Walmart, Target, and basically every retailer that wants you to say yes when your wallet is saying no. And here's the pitch. It is elegant, almost seductive in its simplicity. No credit check, no interest, just split your purchase into 4 equal payments. The first one today, the rest every 2 weeks. Easy, clean, done. On the surface, it looks like a consumer-friendly innovation, a smarter alternative to credit cards, a way for regular people to access things without drowning in 24% APR. But here's what nobody explains at the checkout page. The business model is not built around helping you manage money. It's built around helping you spend more of it. Start with the merchant. When a retailer partners with a BNPL provider, they pay a fee, typically between 2 and 8% of the transaction value. That is significantly higher than what they pay for a standard credit card transaction. Why would a retailer agree to that? Because the data says something uncomfortable. Shoppers who use BNPL spend more. On average, cart sizes go up by 30 to 50% when a BNPL option is available at checkout. Some studies put it even higher. So the retailer pays a higher fee, and in return, they get a customer who was about to leave the site without buying anything and instead completes a purchase, or a customer who was going to buy 1 item and now buys 3. The BNPL company gets paid by the retailer gets a bigger sale, the consumer gets the product. Everybody wins. That's the version of the story they tell you. Here's the version they do not. The BNPL model depends on one thing more than anything else: missed payments. Most of the major providers make a portion of their revenue from late fees. Miss a payment by a day? Boom, $7, $10, $25 depending on the platform. Some cap the fees, some do not. Some charge a fee and then continue charging you weekly until you pay. Some report the missed payment to credit bureaus, which means that sneaker purchase is now quietly damaging your credit score. And then there's the interest-bearing installment loan. Not all BNPL products are interest-free. The 4-payment, 0-interest model is the one in the advertising, but many providers also offer longer-term plans: 3 months, 6 months, 12 months. Some of these carry interest rates between 15 and 36%, occasionally higher. The 0-interest version gets you in the door. The longer-term plan is where the real revenue lives. Affirm, one of the largest players in the space, reported that over 60% of its revenue in recent years came from interest income, not fees, interest, on loans that millions of people assumed were the 0-interest version when they clicked Confirm at checkout. The psychology here is not accidental. You see 4 payments. Your brain processes 4 small numbers, not 1 large number. That's called payment partitioning, and it's been studied extensively. When you break a price into smaller pieces, people are demonstrably more willing to spend more. The pain of paying literally decreases. BNPL didn't invent this psychology, it industrialized it. The companies market themselves as financial wellness tools. Klarna positions itself as a smarter way to shop. Afterpay calls itself a movement toward financial freedom. The language is almost therapeutic. But look at who's actually using these products. A 2023 survey by the Consumer Financial Protection Bureau found that BNPL users are more likely to be financially distressed than the average consumer. They're more likely to carry credit card debt, more likely to have overdrafted their bank account in the past 12 months, more likely to have been contacted by a debt collector. This is not a coincidence. These platforms are not pulling in the financially secure. They're optimized to convert people who can't afford something right now into people who will pay for it in installments. And because the product feels nothing like a loan, the psychological guardrails people normally apply to borrowing simply don't activate. You would think twice about putting something on a credit card, but splitting it into 4 payments, that barely registers as debt. And here's the irony. The thing that makes it feel safe is exactly what makes it dangerous. Fragmentation. You have 4 payments here, 3 there, 2 more somewhere else. No single one feels like a burden, but they're all drawing from the same paycheck, and they all land in the same 2-week window. The CBFP found that a significant number of BNPL users had taken out 5 or more separate BNPL loans in a single year. Not 5 purchases, 5 loans. Now, step back and look at what's happening at a systemic level. Traditional credit infrastructure has guardrails, underwriting, credit checks, disclosure requirements. These are imperfect and sometimes exclusionary, but they exist for a reason. They create friction. And friction in lending is often a feature, not a bug. BNPL, especially in its early years, operated largely outside that infrastructure. No credit check for the basic product, no standardized interest rate disclosure, no unified reporting to credit bureaus, different rules in different countries. Regulators are now paying attention. The UK has been working on bringing BNPL under formal credit regulations since 2021. The CBFP in the United States issued guidance in 2023 clarifying that BNPL providers should be held to the same disclosure and dispute resolution standards as credit card companies. The EU has tightened its consumer credit directive to capture these products. The industry is pushing back, arguing that over-regulation will cut off credit access for people who need it most. And that argument is not entirely wrong. There are people for whom BNPL is a genuinely useful short-term tool with no real downside. But there's a difference between a tool and a trap. And the line between them often depends on whether the person holding the tool understands how it was designed. Here's the thing about buy now, pay later. It's not a scam. It's not predatory in the crude, obvious sense. Nobody's lying to you. The terms are there, the fees are disclosed, the payments are exactly what they said they would be. But financial products don't need to deceive you to cost you. They just need to be designed in a way that makes spending feel smaller than it is, that makes debt feel like a payment plan, that makes a loan feel like a feature. The sneakers cost $120 whether you pay it all at once or in 4 installments. The difference is only in how it feels. And when something is engineered to feel like less than it is, you have to ask a simple question. Who does that feeling benefit? Because it's probably not you.